Hey, what's up guys? John here. We're seeing massive layoffs across the real estate industry, but I think we're stepping into a huge opportunity, an absolute massive opportunity for the smart and savvy investor that really understands what's actually happening right now in this economy. We're being set up for a massive rug pull. The economy is about to get really pulled. If we look at what's happened over the last couple of years, it's very clear. The last couple of years with this quantitative easing, keeping interest rates at 0%, and putting so much money in the system, stimulus, PPP loans, unemployment benefits, basically just paying everyone just to stay home. What happened? People relocated, they left expensive cities, they bought big houses, they overextended themselves, and now we're starting to see a couple things happen right now. It's a couple curveballs that I think are going to catch the entire housing market by complete surprise, and I think the smart and savvy investor is prepared for this. Now, what's happening? Inflation's through the roof. Everyone's aware of this, 20-30% inflation, many would argue. You know, they're reporting 8.6%, but many would argue it's probably 20 to 30%, right? So what's happening? We're seeing wage growth at about 3.5%, meaning the average American is probably losing purchasing power around 20%. That's the spread, right? So if someone's making 100 grand, maybe they have the purchasing power of 80 or 85,000, right? It's huge. But what's also happening right now? Interest rates are rising. And as this happens, the cost to borrow money is going to get more expensive. We're seeing stocks get pulled back, crypto's pulling back, everything's pulling back. People are scared, people are concerned. You look at Compass. It was a real estate brokerage that was expanding rapidly. They're pulling back. Look at Redfin. They're pulling back. You look at Chase, the Chase Bank. They just laid off 1,000 mortgage brokers, right? You look at all of these, Better.com. You look at Wells Fargo. You look at Bank of America. They're all laying people off. Why? It's because the real estate industry is changing, and opportunity for consistent sales, it's getting evaporated. It's getting pulled away. We're seeing less and less multiple offers. We're seeing 20% of all home sellers in America reducing their home prices. Market's changing, right? And with that change comes fear. And with fear comes opportunity. Right now, HomeLight, everyone knows what HomeLight is, right? HomeLight laid off 19% of their workforce, right? And they just raised $115 million, right? $150 million financing. And so it's a business model of consumer-friendly tech to connect home sellers and with real estate agents. The company also matched sellers with investors interested in making cash offers on single-family homes. You know, real estate agents aren't doing, as well as they were 6 months ago. Investors are kind of pulling back. So is HomeLight, right? Look at Sunday.com. Sunday.com laying off 15% of their staff as well. Right? Sunday.com, in just 3 years of existence, San Francisco-based Sunday execs has reported raising at least $135 million in venture capital, expanding into 20 markets across the country. Co-founder and former executives of residential bridge lender Lending Home, Sunday taps into home sellers discontented by real estate agent fees, as well as growing pools of home investors, right? So, of course, they're going to be laying everyone off, right? And housing market competition dropped to a 15-month low. We're seeing this shift. And where I think everyone's wrong right now is that people are so caught up on these 2 points, and they drive these 2 points home as the reason the housing market will always remain strong. One is that there's between 5 and 6.5 million houses that are short, that we're just short of houses, right? And so because of this, supply and demand are going to dictate and determine price. So price is always going to continue rising because we don't have the demand, right? Or we don't have the supply, right? We have excess demand. But the reality is that we're also not taking into consideration what's happening right now to retirees. Retirees own about 40 million homes in America. So about a third of the houses in America are owned by people, in retirement, right? And so what's happening right now? 40% of that percentage are on fixed income. So security, they have fixed incomes. They were anticipating probably a 2 or 3% inflation. Now they're getting hit with 20, 25% inflation. Health insurance is through the roof. Food prices are through the roof. So what's going to happen? Either they only have a few options, really. One is they bring in roommates. 2 is they sell the house. 3 is they'll get a loan out against their house. But how are they going to pay for the loan, right? I think we're going to start to see a lot more inventory hit the market that people just simply are not anticipating, right? And so as we start to see interest rates rise, we could start to see more and more people being forced to sell their homes. So why would interest rates rising have anything to do with people being forced to sell their homes that, maybe they own free and clear, or maybe they have a fixed rate mortgage on it? Well, it's because the cost of existing debt is going to get more expensive. Meaning if they have credit card bills, those credit card bills are going to get more expensive to service. If they have an auto loan, that might get more expensive. Businesses generally contract as interest rates rise because the cost to borrow money is more expensive, right? And so if they're contracting and everyday consumers are contracting their spending, it's going to impact everyone indirectly. And so we could start to really see people in retirement start to sell their homes for a variety of reasons. But I think it's really going to be the affordability crisis, not being able to have the funds to make it. That's what I think is going to happen. I think we're going to start to see a lot more inventory than people are anticipating. And right now, U.S. housing holdups put thousands of jobs on the line, right? And so Reuters, U.S. mortgage lenders, refi companies, and real estate brokerages may lay off thousands of employees in the coming months, industry sources said, as Americans put off buying a home. Now, there's going to be a couple unique things happening here. There's people talking about, the idea of potentially going into quantitative easing, where we start, decreasing interest rates and putting money back into the system. This is possible. This is possible. It's also not possible, right? Anything could happen. And why I say this is because who could have predicted the last 3 years? Really, who could have predicted it verbatim exactly what was going to happen? No one, right? And so to predict the next 6 months or 12 months or 24 months and really have all the answers, I mean, we can connect the dots as best we can, but any curveball coming out of left field that we're not anticipating could really offset every other prediction. And so with that being said, it is possible that we do see interest rates going down or going up. Now, what I think the most important thing is, if you're going to buy a house, you're going to invest in real estate, is that you're buying a property on a couple fundamentals. The one is that you want to make sure you're getting an incredible deal. And how do you know if you're getting an incredible deal? Well, traditional, real estate firms, look at Blackstone, for example. This is a private equity firm in, they have offices all over the world, but they have about $950 billion in assets under management. They're the founder of Invitation Homes, one of America's largest real estate companies. They have like 90,000 houses in the beginning of, this is when they stepped in 2008, 2009. They were really scaling up. By 2011, they had like 90,000 houses. Blackstone found them, right? And so what their model was is they would just look for deals on a discount to replacement value. So what they would do is they'd find out, what the land was actually worth and what is the cost to actually rebuild that property. And then they would simply just look for a discount on those numbers, right? And so, for example, if the land's worth $100K and it costs $200K to build it, then the overall brand new property to replace that would be $300K, right? And so they'd want a substantial discount to replacement. So maybe they'd buy it for $200 or $225, right? And so they'd go in and buy it on this premise. Now, what's happening right now is people are not doing that formula by a long shot. They're just going to buy whatever a mortgage lender will say that they can get approved for. So if you're stepping into an environment like we are right now, where everything's kind of contracting, and you start to see interest rates going up, the interest rates actually could be your friend, because the more expensive it is to actually borrow the money, the less competition you're going to have to actually buy that property. So if you have cash and good credit, you're going to be able to go out there and find a great opportunity. So what I think people should be doing is figuring out where they want to invest, having a really good plan, a really good strategy, being pre-approved for a mortgage, making sure that you can actually get the loan if you wanted it. And they might tell you, your mortgage broker might tell you, hey, you need to do X, Y, and Z, you need to make more money, you need to do this. And then you could work on it from now until then. And then if the market does start to pull back even further, you're already pre-approved, you're ready to go, you know exactly what you want, how you're going to get it. And then you're simply just going out there and looking for, a deal that checks all the boxes, right? If that's what you want to do. You want to really, you want these interest rates to be your friend. Because what happens if we enter quantitative easing and rates go down is you can always refinance your loan and get a lower rate, right? So as long as you're getting a low debt payment that you're committing to, and you get a higher interest rate, but it's fixed, then obviously the rate's not going to be going up. And if the rates end up going down, you could, refinance into that lower rate. I think what many people are doing right now, which is a big mistake, is they're getting ARMs, like a 5-year ARM or a 7-year ARM, saying, you know what, I am going to, take advantage of the quarter point or half a point I'm going to save now, and then, in 5 years or 7 years, I'll deal with it then. But if rates continue picking up, and it is possible, who can predict, right? If rates do continue going up, then that person's going to be in big trouble, right? So I would suggest getting a fixed fixed loan, no doubt about it. Low interest rate stimulus payments and work from home during the pandemic have prompted many millennials to hunt for new homes, fueling a red-hot housing market. But the market is now cooling amid economic uncertainty resulting from the Ukraine conflict, a jump in mortgage rates as the Federal Reserve raises the cost of borrowing. We're seeing a reduction in buying interest because the cost of buying a home, and that's due to both the run-up in interest rates and the ongoing high cost of actually building a home. U.S. existing home sales tumbled to a 2-year low in May, but the median house price rose roughly 15% from a year ago to an all-time high of $407,000, passing $400K for the first time. It's interesting as well because renting is over $2,000 a month. Like, that's the median rent in America. It's unbelievable, right? Who can afford this? Over $2,000 a month, meaning that the average American would really need to make about 60 to 70 grand a year to have their own apartment, when the average American makes about 40,000 a year, right? So people are really, really house poor right now, given what's happening. So if you are one of those people that are like, you know what, I'm wasting so much money in rent, I don't know what to do, I need to buy a house right now, my suggestion would just be to bring in a roommate and just to, maybe reduce your quality of living for the short term and just focus more so on cash accumulation, not so much on being happy in the present day. We have to, as a society, get ready for sacrifices, because we're going to be stepping into a period of sacrifice, and I think that now is the time to sacrifice as much as you possibly can so that you can then pave opportunity, permanent opportunity tomorrow. But don't worry about being happy and comfortable right now if you have the flexibility. Some people, they have a husband, a wife, a spouse, they have children, they can't bring that situation on board. That's okay. But if you're a single person or an individual and you can make those sacrifices, I suggest doing it. I did those sacrifices, and a lot of people do. They'll make the sacrifices in the short term and get the benefits long term. That's I think what a lot of people should be doing right now. This is the time to sacrifice. Rating agency Fitch expects new home sales this year to fall 2% compared to its earlier forecast of 1.8% rise. The U.S. housing industry, which employs hundreds of thousands of people, is responding to the shrinking. Now, yeah, they employ hundreds of thousands of people, sure. But indirectly, they employ millions of people, right? Whether you're an escrow officer, title officer, real estate agent, real estate brokerage founder, you're a broker, you're on a real estate team, you're on a mortgage team, you have, those people have children, their spouses, all these people are being indirectly tied, right? Construction, all these people, right? You're talking millions and millions of people. I would be surprised if the number is shy of 5 million people or 7 million people that would not be directly impacted by the housing market right now. It's substantial, right? A lot of people have benefited immensely over the last 5 to 7 years, predominantly the people in the real estate industry, both indirectly and directly. They were the ones that really won. But maybe even the government probably won more because they're benefiting from the increased property taxes. So the benefit of these property taxes that are continuing to rise is just more money being funneled straight to the cities, counties, jurisdictions, and states, right? These are the big winners. But the state and then the people directly in the industry. But what's going to happen is as the market starts to pull back, we're going to start to see more and more of these situations where we're seeing massive layoffs. This month, real estate brokerage Compass and Redfin both announced hundreds of cuts, right? And as the rate most popular U.S. home loan nears its highest level since 2008, the effects may spread to mortgage companies as demand for refis, obviously wanes. Mortgage rate percentage on a 30-year rate, more than, and I already mentioned this, Chase, they laid off 1,000 people, right? Executives at mortgage firm Loan Depot said its earnings call last month that they were expecting to cut headcount to manage the costs as market volatility drops. A source from Ally Financial Inc. said they're focusing on prudent and essential hiring only. Both firms added about 1,000 employees last year. There's almost no incentive to refi. So that drop off in business, in addition to our view of slowing home sales, suggests there will need to be layoffs across the industry. Even if home sales stabilize, refi volumes are going to be significantly lower than where they were the last couple of years. This is what's going to happen. So home builders already reeling under labor shortages may not announce layoffs due to backlogs. We're going to see. To be sure, healthy backlogs at home builders who have learned their lessons from the global crisis in 2008 show it is not all doom and gloom. I guess we'll see. All right. That's what a lot of people, I think, forget about what 2008 looked like. 2008 was a different animal. We're stepping into, I think, many more problems today as a global, economy. Whether you are in Sri Lanka, you're in Europe, you're in anywhere. Every country, every location has their own problems right now. In 2008, it wasn't so much that same type of dynamic. It was, yeah, there was issues in the housing market, but now we're seeing issues in the job market, we're seeing issues in the mortgage market, we're seeing issues in almost every industry is seeing issues. Some industries are benefiting immensely, but many industries are seeing massive issues, and I think it's going to be a domino effect of problems, and the only solution is to have cash, credit, and a plan. If you need help with your credit score, you want to fix your credit score, my team is absolutely incredible. They're in-house. Cashnow.video, cashnow.video. If you want to learn about real estate investing, how to invest, where to invest, what to do, cashnow.video. And if you want to get started on YouTube, get on the YouTube grind with me, cashnow.video. I'd love to work with you guys. And subscribe. You'll also subscribe on my second channel. It's going to be an interactive call-in show this upcoming week. And follow me on Instagram, TikTok, LinkedIn, and Twitter up in the banner, and I'll catch you guys in the next video. If you're interested in being sponsored on my YouTube channel, visit cashnow.video/sponsor and fill out the application.